S&P falls into a bear market. What does that mean now, and how much more is there to go? That's coming up on today's 3 Minutes on Markets and Money. As of yesterday, the market declined into bear market territory, being down more than 20%. That's that arbitrary measure that we use to calculate bear markets. Now, it's interesting to talk about because, again, if you say, well, the market just got into a bear market yesterday, I don't know about you, but it's felt like a bear market now for the last several months. And again, psychologically, the pressure is certainly there. On an arbitrary measure, we've now eclipsed that 20% level that has classically defined what a bear market is on Wall Street. Two important things here. Markets are now 3 standard deviations below the 50-day moving average. This has been points to where we have bounced previously. Now, some bounces have been better than others, but again, each bounce this year from that very oversold level has been an opportunity to sell. In other words, buy the dip is no longer the in vogue thing anymore for investors. It's more about sell the rip more than anything else. I would expect to continue to see that. Now, a rally back to around 4,000 on the index is going to be probably our next level of resistance that you'll want to sell into and raise cash. But again, a reasonable bounce here, not unlikely because of simply the fact that markets are oversold on a short-term basis. All that overbought condition we had just a few days ago has been completely erased. The MACD buy signal has now been reversed back into a sell, and our money flow indicator back on a sell as well. So all this suggests that markets are going to go lower here over the course of the next few weeks or few months. But let's talk about the difference between a technical bear market and a real bear market. While a 20% decline has classically defined a bear market, what really defines a bear market is when the previous bullish trend of rising prices, that's what a bull market is, prices going up, is broken and prices are trending lower. If we start to look at the markets on a longer term basis, we get a much different picture. Yes, markets are down 21% this year from peak to trough where we are currently, but going back here, looking where we are today, we're still above the 2020 peak of the market. We haven't really violated that. And the 200-week moving average continues to be kind of the point to where markets have found bottoms previously. Back in 2020, the markets did break below the 200-day moving average very quickly and then recovered and immediately went back to new highs. This is a classic type of correction in the markets. The bull market trend of rising prices was never really broken, and the very fast recovery to all-time highs also is part of a bull market correction rather than a classic bear market. Same thing occurred back in 2018. Markets came down, retested that 200-week moving average, and then bounced and immediately went to new highs. Again, another classic definition of a bull market correction. If we take a look at prices along this entire run, we've never really violated that 200-week moving average to any great degree. Now, importantly, markets are now oversold. If we look at our oversold conditions on multiple levels, we are more oversold now than we were really at the bottom of the market in 2020 on multiple levels, and even back in 2018, we're more oversold than we were back then. So when we start to look at the markets on a longer term perspective, we really haven't violated that bullish trend of the markets. All we're really doing is reversing all that liquidity-fueled advance that we had of all that money pumped into financial markets in the economy back in 2020, 2021. That's simply being reversed as that liquidity comes out of the markets now, and we're just simply moving back to where we should have been previously if this market had just gone through a normal correction and a recovery. Instead of having 120% advance to the peak, we would have more likely recovered to some level about where we are now. So it looks like at the moment, if this market is going to go through a more normal correction, what we're going to do is see the markets come down and retest this 200-week moving average, which right now is around 3,500, 3,400 on the S&P. Now, we could go a bit lower than that. Wouldn't be a surprise if we did break below the 200-day like we did see before. But again, around this level, we're going to be challenging this longer-term uptrend of the markets. We're also going to be re-challenging these tops that we set back in 2020. Again, really just returning the market, ex-liquidity, returning the markets back to where it probably should have been based on valuation and earnings growth over the last 2 years, simply returning back to those those levels, just a reversion to that mean, more or less. Really not a bear market, just a correction within a longer term trending bull market. If that changes and we do violate this and begin to create a negative trend in markets, that is what will be a real bear market. We'll be talking about a recession and talking about a much deeper correction of 40 to 50% at that point, rather than 20 to 25 to a 30% correction, which is normal for an economic recession. That's 3 minutes on markets and money. See you back here tomorrow.